This morning's data shows UMBS up 3/8, while the 10-year Treasury yield dropped 7 basis points to hover under 4.37. This comes while global oil prices remain high, pressuring inflation. Simultaneously, there has been no de-escalation in the Iran conflict. Bond pricing dictates that yields should be rising to account for inflation risk and geopolitical tension, yet they are falling. Why are bonds finding buyers in an environment where the data suggests a sell-off? For mortgage professionals, distinguishing a technical glitch from a true trend reversal is necessary to protect margins on a rate sheet. This rally reflects the conflict between market microstructure, the mechanical rules of trading, and macro fundamentals, the overarching economic reality. On volatile days, the structural plumbing of the market can dictate price action more than the morning news. 3 specific technical drivers engineered this overnight rally. Identifying these factors is the only way to accurately price risk today. Our investigation begins Friday morning, hours before weekend headlines could influence the market. The first driver was a correction in Fed funds futures. This represents a mathematical repricing of short-term rate expectations, occurring independently of the geopolitical news cycle. This correction extended from Friday into Monday morning, establishing a foundational layer of price support. This momentum was established before any of the weekend's geopolitical uncertainty could be priced in. This initial layer provided a structural cushion, showing the rally had mathematical origins before traders reacted to the news. By Friday afternoon, market behavior shifted. As the trading week drew to a close, institutions moved capital into bonds as a safe haven ahead of the weekend. Traders accept lower yields to avoid portfolio gap downs in case of a war escalation while markets are closed. When the Monday opening bell rang, a second bar appeared, the relief reaction. Because Monday opened without a major escalation in Iran, the market digested the status quo. The lack of new negative headlines allowed bond prices to recover simply because the worst-case scenario did not occur. This phase of the rally was driven by the unwinding of Friday's defensive positions, not improving economic data. The final factor is the date itself, March 30th. This marks the period for institutional portfolio rebalancing at month-end and quarter-end. Large funds are often required to buy or sell specific assets to meet allocation targets at the end of the month. This mechanical buying creates localized momentum specifically for bonds. This calendar factor provided the push that finalized the 3/8 gain in UMBS. Much of this rate improvement is the result of institutional housekeeping, where buyers are following mechanical mandates rather than reacting to value. When we zoom out to a multi-month perspective, this 3-day rally appears as a minor blip on an upward trending yield line. Energy costs and geopolitical instability continue to push the trend higher. It is common to look for a sellable downward trend to offer clients, but extrapolating a long-term recovery from a 3-day volatility glitch is a mistake. This was a recovery on a Monday, but it is not evidence of a reversal. A drop in yields driven by technical housekeeping will evaporate when macro fundamentals reassert control over the trading floor. A true trend reversal requires a shift in the data, such as a collapse in oil prices or a signed peace treaty. Today, none of those shifts have occurred. Do not leave client positions exposed hoping this technical rally extends through the week. The rally was the product of the futures correction, defensive weekend hedging, and month-end buying. Until the macroeconomic drivers shift, professionals should treat sudden rate improvements as temporary noise. Market mastery involves identifying why rates dropped and recognizing they have no reason to stay there.